How important do you see what's going on in the housing market is to the risk of recession?
So with the home ownership rate, give or take, call it 65%, 65% of households owning a home with the balance that rent. So firstly, we're seeing a sharp decline in the pace of transactions, of new transactions, as the first-time buyer, and the first-time buyer is the one that gets really screwed here, because those that already own a home are sort of playing with house money. They've benefited from the rise in home prices that are up 20% year over year, on top of a sharp increase the prior year. So there's a pool of equity in
prior decade, but yeah.
Yeah, private, exactly. So there's a pool of equity cushion that existing homeowners sort of are sitting on. But that first-time buyer, there's no way a first-time buyer will be able to buy a home that's priced, or a new home at least, priced less than $300,000. You know, so that is sort of a new world that we're in. So prices them out, it forces them to rent. And we know rent prices have been very aggressive over the past year.
Past
2 years. For new leases, they're running at 15 to 17%. If you're rolling over an existing one, it's still probably 10%, or I should say maybe high single digits with a net aggregate about 10. So the first-time home buyer getting priced out. So with the existing owner of a home, well, I can't remember what the stat is, but I think it's north of 75%, probably more than that now, have a mortgage with a 3 handle or less. So now you have not mortgages at 4 or at 5, but as you said, touching 6. So the existing homeowner, unless they need to move because they need more space or they want to downsize, they're not giving up that cheap mortgage so quickly to go into a higher cost mortgage. So they're not going anywhere. The first-time buyer is taking their time because they don't want to pay those high prices. The investor class, which has been a big driver in housing over the past couple of years in the single-family rental business, where in some markets they're almost a quarter of purchases, well, you have to believe they're going to start questioning the IRRs of their new incremental purchases. So it puts a freeze on the entire industry, whereas where so much then goes off that. So if there's less housing turnover, there's less new renovations being done. Yes, you may want to just redo your existing house, but people have been doing that the last 2 years through COVID. They put the deck on, they redid a kitchen, they put down new flooring.
And sorry to interrupt you, but they were doing that with much cheaper, like home equity loans rates, right? So it's a lot easier to borrow to do that 2 years ago than it is today, right?
Absolutely. So now they're doing it. Those existing homeowners are doing it less on their existing homes. They already did it. And you are then taking away the possibility of, okay, I just bought this new house. I need to repaint it. I need to resand the floors, and I need to touch up this or do that. Well, less transactions means less of that too. So the ripple effects are broad. You know, we go back to the Fed. You know, the Fed manipulates interest rates. The 2 most interest rate sensitive parts in the economy are housing and autos. The influence of manipulating interest rates on other things is much more difficult to quantify. But housing and autos is very easy. And I read an article over the weekend about car prices, new car prices, reaching another new high, to the point where they're almost averaging where median income is. And the only way someone making 50 grand can afford a car is through cheap money. And money is not so cheap anymore.
Not cheap anymore, yeah.
So what a lot of people are now doing, that have leased, you know, it pays for a lease that's now expiring. It pays to exercise the option on that lease and buy the car, because the used car value is worth more than probably 3 years ago when you initially bought that car and where your option price is. So you can buy the car and then flip it. But then, of course, you then have to go out and buy a new car.
Right.
So it actually pays to buy it. But if you don't have the money to pay for it and you want to finance it, which is fine to do, you're having to pay up more than 5% interest rate on the money that you're going to borrow to pay off the car and then own it scot-free. Whereas before this sharp rise in interest rates, the cost of that was much less. You had 0% financing, and you were able to term out 7 to 8 years, and or you had maybe at most 1 to 2%. So it's a whole new world with these big ticket items.
Yeah, it's the worst of both worlds, right? It's still record prices, at least with new cars, yet the highest financing rates we've had in forever anybody can remember, right? And you talked about, the cars and housing being sort of two of the most interest rate sensitive sectors, which is true. I would say housing is even more so where the Fed's involved because the Fed first sets, the federal funds rate, which influences interest rates. So that's one way it influences mortgage rates. But then the Fed has also, until recently, been out there being the big buyer in mortgage-backed securities, right? So it's been keeping the cost of that debt low. And now it's no longer buying them anymore. And you have to figure out where the next marginal buyer is willing to set the price, right? Which is higher, right? So to use your terms, it's sort of a new world, right? And that's where I want to go with all this, because lots of reasons to expect that housing prices could go lower and maybe materially lower in a lot of areas over the next 1 to 2 years. And if you're interested in a really deep dive into this discussion, I recorded an interview about 10 days ago with Nick Gurley, who's a housing analyst. I'll put up a link to that video here. You can go watch it. But we haven't even mentioned factors like inventory and whatnot, Peter, where there's now suddenly a lot more inventory that has been coming onto the market in past years, hitting markets in a lot of these areas right as demand is beginning to slow. So it's kind of creating a bit of a perfect storm. So now I want to go into the recession question, because you did confirm that, hey, what happens with housing really does have a massive influence on the wealth effect, because so many people own it, and even rental prices are a function of what housing prices are. And even those people you mentioned who are sitting on a lot of home equity, still, if you've heard that your house has lost 20%, if all of a sudden your house is worth 20% less than it was before, even if you're not planning on selling it, you still feel a little more fiscally conservative because you have less cushion than you did. Right. So one thing we haven't talked about yet, though, which would definitely also hit housing, is layoffs. So if this recession that we're heading into is big enough to have material layoffs in it, well, then to your point, yeah, if you're sitting on a 3% mortgage, yeah, you'll sit and just try to stay put for as long as you can. But if you lose your job and have to move for reasons that aren't really if you're being forced against your will, maybe to make the decision, as some people may have to be, then you just sell your house with what you can get for it. And the house, just like stocks, houses are priced at the margin, right? You just need a couple houses in your neighborhood to go for 15% below the current market value. And all of a sudden, everybody's houses are repriced downwards. So now we're at the recession question, Peter. What odds do you place at it, and how severe do you think it could be?
So because nothing is 100%, I'll say there's a 99% chance that
I like how you left yourself some wiggle room there.
Yeah. So in case I'm wrong, I can say I didn't say 100. The extent of it is a good question, and something that I know a lot of us are trying to think about, whether it's going to be mild or severe. And it's tough to say, because usually when you look at the pendulum, the severe recessions follow the very fast growth, because you really swing in the other way. Whereas if the recovery is somewhat mild, the recession could be mild as well. And the problem, this economic cycle has been so screwed up by COVID that it's almost tough to define. Did the expansion really start in 2009 and just temporarily disrupted in 2020? Or did it really begin in the depths of 2020 to continue now? I don't know. What I'm more worried about, because when you get if you get a short recession, they have a tendency of also snapping back quickly, just sort of like a V type situation. I think what potentially could be more worrisome is a mild one that stays mild, and that sort of a malaise kicks in, where, let's just say the Fed sort of pivots, they start to cut, but because this economic adjustment needs to take place, we don't really respond to a lower cost of capital, and that we get into this rut, and that US growth sort of goes back to maybe 1.5%, where it would be maybe 0.5% labor force growth and no better than 1% type productivity growth. That's somewhat lasts. Sort of like the mid 2010s. We had rates at rates at 0 for 7 years, did nothing, all this QE, and growth just was sluggish. We can also debate that. That's for a variety of factors, but I'm more worried of just that than a sharp recession. Because like I said, sharp recessions have a tendency of snapping back quicker, where a mild one doesn't necessarily lead to a sharp rebound.
Okay, so let me tug at that for a little bit. Totally understand the concern there. You can almost look back at the mid 2010s now as like the salad days, right? So debt is higher now, and that's pretty much always true every decade, but debt's higher now, but certainly inflation is a lot higher now. So if the Fed pivots before taming inflation, you have a much higher cost of living going on. I guess my question is do you think we could even go back to those days of just kind of anemic growth? Because it seems like we've got a lot more weighing down the system right now, fundamentally.
Yeah, that's the scenario that I'm most worried about. Sort of like a Japan type situation where you'll get some periods of economic expansion followed by some moderation, where there's just not this sort of long runway of robust growth that we've seen.
Yeah, you just can't get back to escape velocity. You just keep staying kind of mired.
Yeah, because what are sort of the next things that we're gonna sort of bubble blow again? We've bubble blown so many things that you're almost running out of things to bubble blow. And now that you've bubble blown sovereign bonds, to use that as, to me, the epitome of this financial bubble, because you can argue that it's the greatest financial bubble in the history of bubbles.
Yeah,
it's tough to figure out what is going to lead to that next short, big economic expansion that's not driven by credit, because we're so now dependent on credit.
If you enjoyed this video clip, click here to watch another one you should like.